This AMA is designed for everyone who is curious about crypto, whether you are just starting your journey or already have experience in
Yeah, I'm
trading,
here.
investing, or exploring
we
digital
not, we are
assets.
not live
Over
yet,
the
right?
next few minutes, you will hear informative
No, I don't think
discussions,
so.
updates,
Can we
and
do
valuable
it quickly? I
perspectives
have to
that can
drink
help
today.
you stay informed and make smarter decisions in the rapidly evolving crypto ecosystem. Our goal is to provide a platform where participants can learn, ask questions, and engage with experts.
Wallets and also payment apps and chains. Um, when we talk about the DeFi protocols, they often do the hard work of building the use cases. They attract users, they create liquidity, and also give stablecoins somewhere to be used. So the uncomfortable question, which I would like to throw to our guests in the room, I'm going to be introducing you guys very soon, of course, but I want to give everyone a sneak peek of what we are about to discuss. After all these years, are stablecoin companies becoming the real financial institution of crypto, while DeFi protocol gradually become, distribution channels? There are also, a second question behind that, which I would like to ask as well. If the reserve behind stablecoin generates income, who should actually receive the value? Is it the user, the protocol, or the user whose capital ultimately supports the stablecoin? And then again, we have AI agents as well. If software agents begin paying for data, compute, digital services automatically, stablecoin may sort of, find a completely new source of demand that has, very little to do with, crypto trading. Can you hear me clearly? Can you hear me?
Yes, all good.
All right. So today we want to, look at stablecoin as a financial business model, not simply as a token. So joining us today is Paula, the CEO of AetheriumX, and Mr. Mike, of course, who is currently on board, the head of AI and Americans at AetheriumX. Paula, Mike, welcome.
Thank you for great intro. Pleasure to be here and happy Friday, guys. So I think this is a very good topic because stablecoins have become one of the clearest examples of where crypto is actually connecting with the real economy. And once that happens, the question naturally becomes who controls that connection and who captures the value. So happy to discuss today. Mike.
Yeah, thank you for having me. I also think today's topics are going to be quite interesting to go over, and this is going to be an important part of AI because the AI agents are going to be the driving force in the next couple of years when it comes to generating stable growth, and also they're going to have a huge impact on traditional crypto users.
All right. Thank you guys so much for coming on board, of course. Let's start with the most provocative question of the question. Let's circle back. Tether and other large stablecoin issuers, they're holding reserve assets, they're earning income on those reserves, they're controlling redemption and, increasingly operating through regulated financial infrastructure. So this question is over to you, Mr. Paula. Are they becoming the new banks of crypto right now?
I think economically, there are definitely similarities, although I would not say they are simply banks under another name. The interesting part is that users give the issuer something very valuable, access to capital, right? The user holds the stablecoin while the issuer holds the reserve assets behind it. If those reserves are invested in short-term government securities or other cash-like instruments, the issuer can earn income while the user usually receives a token that remains worth of $1. That looks similar to a very simple form of deposit economics, but the issuer also has responsibilities. It needs to maintain liquidity, process redemptions, manage banking relationships, and operate with regulatory requirements. So I do not think it's fair to say the issuer is simply taking the yield without doing anything. What has changed is the amount of power that it sits at the issuer level. So if you control minting and redemption, you already control the connection between the on-chain dollar and the traditional financial system. So if you also have strong regulatory relationships and distribution through major exchanges and wallets, that becomes a very strong moat. For me, the biggest advantage is probably not any of those things individually. It's the combination of trust and distribution. A stablecoin needs people to believe they can redeem it, but it also needs to be everywhere. If the asset is accepted across exchanges, payment apps, DeFi protocols, and different chains, that network becomes very difficult to reproduce. So yes, crypto originally wanted to reduce dependence on banks, but in practice, we may be creating a different kind of financial intermediary. The difference is that these intermediaries operate on blockchain rails and their products can move much more freely across applications. So that is not necessarily a failure. It's more a sign that financial system always create institutions around trust. Back to you.
Thank you so much, Ms. Paula. Over to you, Mr. Mike. I've been anticipating your words. I wanted to hear your view. Do you think the real world is actually regulated?
Yeah, so regulation is definitely part of it, especially these days. Technology is still easy to copy compared with trust. So creating a token that is going to track the dollar is not the difficult part. The difficult part is convincing the users, exchanges, institutions, and regulators that the token will still work under stress. That is where reserve management, compliance, and redemption become very important. And I would still put distribution very high on the list, but you can still have a perfectly designed stablecoin. But if nobody is gonna use that and accept it, the product will have only limited value. Stablecoins can become powerful because they are liquid in many different places at the same time. So this is why I think the biggest issuers are becoming more like infrastructure companies than simple token projects. But they're sitting underneath a growing number of financial products.
Thank you so much, Mr. Mike. Let's move to the most controversial economic question right now. I believe it's very, very important for the sake of the audience at Binance Live right now. We want to know, there are three groups contributing value here, some of which you have actually imputed from the start. The issuer manages the reserves and redemption, right? DeFi protocols create lending. We talk about trading and liquidity as well. Users provide, the capital and also, they take risks such as depegging or freezing. So we want to know, Ms. Paula, who should actually receive the yield generated by the system?
That's a good question. I think the first thing we need to do is separate the different types of yield because crypto often mixes them together. So the yield generated by the reserve assets is one thing. The interest earned through DeFi lending is another. Trading fees are different again, and token incentives are not the same as any of those, right? So once you separate them, the economics become much easier to understand. So for a traditional fiat-backed stablecoin, the reserve yield naturally sits with the issuer under the current model. The issuer provides the operational structure and promises redemption at par. So the reserve income becomes part of its business model. But But users are becoming more aware of what happens behind the stablecoin. If short-term rates are high and the reserves generate meaningful income, users naturally begin asking why they receive none of it. So that is why yield-bearing stablecoin products and tokenized money market products are becoming interesting. I do not think this means not yielding stablecoins disappear. They may remain very strong for payments and settlement because simplicity matters. A payment asset does not necessarily need to behave like an investment product. But once user is holding stablecoins as savings rather than using them for transactions, the question becomes different. Then yield becomes much more important. This creates an opportunity for DeFi as well. Protocols can take a stable settlement asset and build different risk and return products on top of it, but they need to be clear about where the return actually comes from. At AetheriumX, this is also one of the reasons we are spending so much time improving the DeFi experience around the product itself. We recently completed a major system update across the account structure, wallet, DeFi models, staking certificates, what else? Deposit flow, and user service layer. So some users will mainly notice the UI changes because we are cleaning up a lot of older interface issues. But the deeper reason is that we want yield products to be easier to understand inside one connected system. So the user should not have to move through 5 disconnected interfaces just to understand what they own and where the return is coming from. That update is only the first step. We are building the system foundation now because the next phase will involve much broader ecosystem integration. Back to you.
Thank you so much, Ms. Paula. Of course, guys, if you need more information or if you have more questions, you can always go to Crypto Solution, and you can click on the link that is currently trending in the community. Of course, it will take you quickly to the Telegram channel. You can ask your questions over there. I'm sure they have moderators who will be answering any technical or basic questions which you have. So over to you. Would you say that the market eventually forces more of the yield back towards the user?
Mm, uh, Probably in some products, yes. Competition tends to push value toward the user if there is no strong reason for one company to keep all of it. But the user also needs to understand that the higher yield usually comes with a different product structure. A stablecoin used purely for settlement and yield-bearing token are not necessarily the same product, even if both are denominated in dollars. Um, Maybe Mike can add a bit of his insights here as well.
Uh, yeah, she brought up some good points, so I do agree. But I think the mistake would be assuming that all stablecoin yield is the same and belongs to one side, which is not the case usually. The user may deserve compensation because it manages the reserves and the redemption. The protocol may also deserve the fees because it's going to create the landing or trading market, and the user may deserve a part of the return because they provide the capital that is used by the platform. So the interesting part is going to be how competition is going to change the split between those different parts between the groups.
Thank you, Mr. Mike. Thank you, Ms. Paula. Now, you see, there's a major question here. Of course, it's sort of resonating in the minds of the listeners as well. So I think I speak for everyone if I ask this question. Is DeFi becoming a distribution channel? So we're going to be going into that, and Ms. Paula, you're going to be giving us some very good insight into this question, as well as Mr. Mike. Um, let's get to the question that may be, very uncomfortable for DeFi. Protocols spend money on time, sort of educating users, creating liquidity, and also building lending markets and managing smart contract risk. But at the end of the day, the user may still be holding USDC or USDT, which is ultimately the stablecoin which we've been talking about from the start. And the issuer controls the underlying relationship with the data, with the dollar, right? So is DeFi basically helping stablecoin companies acquire users and deposits?
I think that risk is quite real, especially for protocols that do not own a meaningful relationship with the user. DeFi used to think that the smart contract itself was the product. So if the protocol was open and permissionless, then the front end was almost treated as replaceable. Commercially, yeah, I think that is becoming much harder to believe, Users do not experience a smart contract directly. They experience a wallet, an interface, a product flow, and customer relationship. So if the stablecoin issuers own the asset and the wallet or exchange owns the user, the protocol in the middle can become very replaceable. So that is where distribution becomes extremely important. The crypto native market is already a fairly mature pool of existing users, and many protocols are competing for the same wallets and the same liquidity. So the real incremental user base is much larger in Web2. For example, Robinhood is a very good example. Its strength is not simply that it can add crypto products. Its strength is that millions of users already know the platform and trust the interface. So when it adds a new asset or a tokenized product, it's distributing it into an existing relationship. That is much more powerful than launching another protocol and hoping users discover it. So I think DeFi protocols increasingly need to think about whether they own distribution or whether they are simply supplying a financial function to somebody's else users. And this is also connected to the recent AetheriumX upgrade. We do not want to treat the update as just another visual refresh. Yes, the old UI had legacy issues, and we are making substantial improvement there, but the bigger work is underneath. We have been restructuring how the account system, wallet, DeFi functions, staking certificates, and deposit process connect with one another. So the idea is that the user should enter one ecosystem and feel that these parts of the same are parts of the same financial product. So that matters because the protocol only provides one isolated function. Someone else can easily own the distribution layer around it. So the current update gives us a new foundation, but we still have much more planned for the next stage. Back to you.
Yeah, pretty interesting. Thank you so much for that insight, of course. It has actually done a lot to answer, that question, of course, because I started with a big question. I say, also let's cover the side of innovation, right? So, talking about protocol issuing to stablecoin, is that product innovation or is it simply defensive?
So both. If a protocol relies entirely on somebody's else stablecoin, it's giving away part of the economics and part of a strategic control. Launching its own stable asset can help a protocol internalize some of that value. But issuing a stablecoin is not easy. You are taking on liquidity problems, risk management, redemption expectations, and potentially much more regulatory exposure. So it only makes sense if a stablecoin is deeply connected to the protocol's actual product. So creating another stablecoin simply because everyone else has one does not automatically create value. And yeah, that's my point. Mike, do you have anything to add here as well?
Yeah, I would also say that the future of competition may be less about who's going to issue the stablecoin and more about who controls the points of usage. So best way I can explain this is by having two stablecoins that have kind of the same usages. but the user may not care which one is better. There's like a lot of products that are probably better than some, but people still use the one that is more popular, right? So they usually just pick the one which is the most convenient and the most integrated into their wallet, trading application or payment service. Like for example, Apple ecosystem would be a good example. Instead of buying other watches, people are usually going to buy Apple Watch if they already have iPhone, and vice versa. So that means distribution can become as important as the actual issuance of new tokens.
Well, that's very interesting. I think, we are sort of delving to a very interesting question, which I would like you to answer, Mr. Mike, of course. Let's shift to AI agents, right? The industry increasingly talks, about agents buying data, paying for APIs, purchasing compute, and even, paying each other automatically. So what we want to know now is, why would those agents need stablecoin instead of credit cards, bank APIs, or platform balances?
So I think the strongest argument to answer your question would be that stablecoins are naturally compatible with the software that people are using, right? So traditional payment systems were designed around human users and institutional accounts. They work to an extent for those use cases, but they have many different layers of authorization and geography built into them. An AI agent may need something different. So imagine an agent purchasing a small amount of data from another device or paying for 10 minutes of compute. The transaction may be quite small and it might happen automatically, right? Stablecoins are, at the moment, they're kind of suited to that because they can move programmatically and they do not require the agent itself to have traditional bank account. Um, with that being said, I think the industry sometimes jumps too quickly from the idea to saying AI agents will suddenly create enormous payment value. The payment itself is actually the easy part. The hard questions are going to be the authorization and responsibility behind those protocols. So how much money is the agent allowed to spend? Who defines what it can buy? What happens if it sends money to the wrong address? What happens if the service is fraudulent? There's a lot of harder questions to ask, and probably we cannot answer that because we don't have the solution to those problems as of now. So next important infrastructure may not be the stablecoin itself. It may be the wallet and permission system around the agent itself. For example, an agent could have a wallet with a daily spending limit and a whitelist of approved services. It can operate automatically within that framework, but it cannot suddenly transfer the entire treasury because the model made a bad decision. So this is where AI and on-chain infrastructure fit together very naturally. So at AetheriumX, our view has always been that AI should operate as an execution and decision support layer rather than becoming an uncontrollable black box. So the same principle applies here. Autonomy is useful when the boundaries are clear. So it's a complex topic, and if you would like me to add more on that later, we can talk more.
Yeah, so would you call agent payment a real use case today, for, or is it just mostly a narrative?
That's a good question. So I would say it's a real emerging use case, but the market is still quite early. The demand is out there. It exists because software increasingly needs to interact economically with other software, right? Uh, Imagine you bring a lot of people into the city. Other people gonna interact with other people. Kind of the same thing with products. But before it becomes a large market, we need we need to better identify the wallet permissions, fraud controls, and dispute mechanisms. So the winner may not simply be the company issuing the stablecoins. It could be the platform that solves those surrounding problems, not just for us, but other companies too.
Also, I can add something from my side. So, and I think this connects actually back to the earlier discussion about distribution. If AI agents eventually become another class of economic participant, someone still needs to provide the wallet and define where the agent can transact. So again, the point of control may move toward the interface and infrastructure layer. Back to the host.
Thank you. Thank you so much for that. Um, it's been pretty interesting. Before we close, I want to bring the discussion back to AetheriumX itself. We spent most of today talking about stablecoin, talked about distribution, wallets, user success, and also how important it is for DeFi platforms to control more of the user relationship rather than becoming only a back-end financial layer. So, what was the main goal of this phase one upgrade?
I think we are losing you. You're muted a bit.
Yeah, can you hear me?
Yeah, we can hear you now.
Yeah, so I said, what was the main goal of this phase one upgrade?
So the main goal was to rebuild the foundation, as I said earlier. Some users will immediately notice the new interface because we have been addressing a lot of older UI and usability issues, but that is only the visible part of the upgrade. The more important work happened underneath. So we have been reorganizing the account structure, wallet experience, DeFi access, staking and restaking flow, also staking certificates, deposit process, and user service system. So they work much more like closely together. For example, Wallet 1.0 is becoming the main asset entry point. Users now have a clearer view of their assets and ecosystem access. We also improved LSCP staking and restaking, so the experience it's easier to manage, and the new daily earnings model gives users a much clearer view of XCT and VXA rewards. What else? So another important change is the new staking certificate system. For normal dApp users, the migration is designed to be as seamless as possible. They do not need to register again, change their wallet, restake their assets, or manually migrate certificates. For eligible external wallet certificates that match the normal mapping relationship, the platform has already completed one-to-one mapping through the SOBO and DCIP infrastructure. We also upgraded the deposit flow. Users now have clearer transaction confirmation and arrival status. The options such as QR code deposits and direct wallet signature flows. What else? And we added something that I think becomes more important as the ecosystem grows, a proper ticketing system and AI customer support. The free sometimes acts as if user service is a Web2 concept that does not matter. I completely disagree with that. If you want mainstream users, they need somewhere to go when they have an account, asset staking, or a system issue. A good financial product is not only a smart contract, it's also the entire experience around the contract, right? So to sum up, phase one was really about making the system more connected and creating a stronger operational foundation. Back to you.
Thank you so much. So, from the technology and AI side, Mr. Mike, what is the most important? What is most important about this specific upgrade?
Well, thank you for the question. So for me, the most important part is that ecosystem is starting to behave more like single system instead of several separate products. So a user should not feel that the wallet is one product, DeFi is another product, staking is somewhere completely elsewhere, and GameFi and PredictX are completely separate environments. The infrastructure needs to connect those experiences. So that is why the account system and wallet layer are really important. Once those foundations are stable, you can connect more applications on top without actually forcing users to learn a completely new flow every single time. And the AI customer service is also a big contributor to that. In the first stages, AI is mainly helping users understand common questions, product operations, and system navigation. But over time, AI can play a much larger role in helping users understand risk, how how their other positions are going to be managed, and it can also interact with more complex DeFi products on the sideline. But again, we do not see AI as just a simple black box that takes control of the user's assets. We see it more as a layer that is going to simplify things for the customer and make it much more easier for them to uh, understand the system. So that becomes more important um, with AetheriumX when it comes to connecting the wallet, DeFi, DCIP, PredictX, GameFi, and other on-chain applications into one ecosystem. So the user experience needs to be more simpler, while the infrastructure behind it becomes more sophisticated. And we are we're on a good path to achieve that if we haven't done mostly. So I hope that answers the question.
Perfectly. We just want to know: is this only for phase one?
I think Paula can answer
Yes.
that.
Yeah. Yeah, so phase one is the infrastructure rebuild, and it's not the final version. So the second phase is where we begin expanding more of the ecosystem on top of this foundation. The current plan is to begin phase two before the end of August. That will include a new NFT system, NFT fragment upgrades, the return of the existing team functions, a new GameFi structure, more on-chain games, a PC version of AetheriumX, and additional ecosystem applications. But I think the most important point is not the individual feature list. We are trying to connect the different parts of AetheriumX more closely. The wallet should connect naturally with DeFi. Staking certificates should connect with a broader DCIP framework. Um, AXNT and VXA should have clearer roles across the ecosystem. NFT, GameFi, and PredictX should not feel like unrelated products added to the same website. We want them all to like connect and work seamless. So that is the direction of the next stage. So phase one rebuilds the foundation. Phase two starts using that foundation to expand the ecosystem, and there will be more changes after that. Back to Mike, if you have anything more to add.
Um, yeah, I think what you just said connects pretty well with today's discussion. We talked about how DeFi can become only a distribution layer if it does not control the user experience, but AetheriumX is moving in the opposite direction as of now. The goal is not simply to add another DeFi product, it is to build a more complete user environment on top of that, where the account, wallet, financial products, data support, and ecosystem applications will all be connected into a single system. That gives AetheriumX a much stronger base for future integration with stablecoins, AI-driven services, and other forms of on-chain finance. So I think the future is looking quite bright, and hopefully next time we can talk more about the upcoming features that are planned out as of as of this moment.
Thank you so much. That is a very good place to finish. Of course, we are almost wrapping up. Time flies when you're having fun. Today, we started with a very provocative question. Stable coin users becoming the new bank while DeFi becomes their distribution channel? The answer is probably more, complicated than that. Of course, our guests have actually done justice to those questions. Thank you so much, Mr. Mike and Ms. Paula. Stablecoin issuers control the underlying assets and, the redemption infrastructure. When we talk about DeFi protocol, they simply create many of the financial use cases. Wallets and payment platforms increasingly control, the user relationship. And also, when we talk about AI agents, I think they may eventually become another class of transaction initiator. So, the real competition is sort of moving towards the layer that connects all of these things together. So that is also why Ethereum Phase 1 upgrade actually matters, and that's why we're actually talking about it right now, pitching it to the users and also the listeners at Binance Live. It's a great audience. The visible UI sort of changes is to see a stronger system foundation across the account structure. We talked about the wallet 1.0, DeFi staking certificates and deposit flow, user support, DCIP, GameFi, and PredictX, so on and so forth. If you have more questions, of course, you can send your questions to your Telegram. Phase 1 rebuilds the infrastructure. Phase 2 sort of begins expanding what can be built on top of it. Mr. Paula, Miss Paula, and Miss Mike, thank you both, for joining us. It's been amazing.
Thank you too. It was a great discussion, and the guys have a good upcoming weekend.
Thank you. Thank you so much for having me, and hopefully we can go over this soon next time. Have a good afternoon,
Yeah,
evening,
definitely not the last
wherever
time.
you might be, and hopefully um, we're all gonna have another meeting quite soon. Thank you.
All right, thank you to everyone for watching at Binance Live. And of course, don't forget to follow AetheriumX for more updates around DeFi, stablecoin, AI. See you next time. And of course, we will be waiting for your questions in our Telegram community. Have a
Bye
good
bye,
day, guys.
guys. Bye.
Bye.